Hey, Tom here, Flip Anything USA. So today I'm going to do a review on Clear Value Tax. The title of this video he produced is Housing Market, My Updated Prediction on Home Prices in Real Estate. Now, I'll be honest, I've never watched one of his videos before. The guys that do predicting based on data, and I saw enough of this to do that it looks like he's just kind of a data miner, in my opinion, are not the people that a real investor needs to follow. There's some global things, sure, that happen. And just so people that come in here for the first time, look, I've been investing in real estate for 42 years. Since I was 19 years old, I've bought property every year for 42 years. There have been ups and downs and crashes over that time, and I've made money in every year, and you can too. I'm about making money. If you're somebody here that's interested in making money, then hit that like button, hit that subscribe button. You won't regret it. That's all I do, no fluff, just to the point. And I show you all the mini properties I bought where I built quite an empire. Made my first million in the 80s, and I've made tens of millions of dollars since.
It's the best thing I ever did.
All right, so let's get this started. I may speed him up if he talks too slowly for me. So let's take a watch.
Today's video is your real estate update. We're covering the housing markets. And to save you the suspense, no, we did not get a housing market crash. So I'm going to show you the data, and then I'll give you my forecast. So this is a 3-year chart of home prices, and this is coming from Redfin. The median sale price of a home in August was $420,846. Compared to July, home prices fell by $1,291. Year over year, home prices are up by 3%.
Yeah, so again, this is what I call already, he's someone that is talking to retail investors, speculators maybe at best. But look, Redfin, Zillow, all these different sources for real estate data, they're just one point of information. I can tell you that I consider, other than interest rates, I'm really mostly only affected by my 20 square miles or 20 mile circumference around me. That's what affects me, because I'm an investor. I own a lot of rentals, and I buy and I flip property. So, but really all I'm concerned with is my little geographical area. I don't need to worry about the entire USA. Now, the things that happen federally, the interest rate going up, that has an effect, but doesn't hurt me financially. I can make money, if I'm smart, and I am. I sense when interest rates I lock in a fixed rate. When things are, on the downcline or I feel good, I've had variable rates for a very, very long time. I haven't been damaged by the interest rates going up like so many other people have. So let's keep watching.
So month over month, home prices are down, but year over year, they are up. Moving on to housing inventory. There are currently 1.51 million homes listed for sale. This is up a little bit from 1.47 million compared to the prior month.
Again, this is something that if you really want to be concerned with this, you should just be concerned with that number locally. Okay, listen, if a big, if an aircraft industry area like Everett, Washington, where they have, Boeing, or a big aircraft area like in California, have Lockheed Martin, they've got, several, McDonnell Douglas, a big aircraft, if they lose a big contract, they can be devastated locally. Big, car manufacturing. They can be devastated. Oil, you cancel a pipeline in South Dakota, all of a sudden, and it wouldn't matter how good a times we're in. That thing got canceled, devastates the area. So keep in mind, I'm not big on this, when somebody's talking about millions of homes, they're covering way too big a geographic area for you to be concerned about.
So it's basically unchanged, as you can tell by the graph. Year over year, the number of homes for sale is down 18.6%. And that's not good if you're rooting for a housing market crash because, well, if you want to crash, you need more selling pressure than buying pressure. But there are
Again, I think it's just crazy for a young guy like this, unless I don't know that he owns a lot of real estate, but to make the predictions he's making. Yeah, we're going to have some problems for sure, and we will have some crashes, but not across the board.
less sellers compared to last year. Now, I want you to take a look at this. This is a 5-year chart of the percentage of homes that are selling above list price. 36.2% of homes are selling above list price. So in other words, more than 1 out of every 3 homes are selling above list. So that number is coming down a little, and it's...
So look, let me just tell you something. Every property I list, I don't care if it's good times or bad times, every property I list sells for above my list price. That is a strategy. In fact, if you haven't got my book and you're interested in real estate, get my book, Wake Up and Smell the Real Estate. It's been a bestseller on Amazon, Audible, and Kindle. You could be reading it or listening to it in just a few minutes. I think it's chapter 24. It's called Leapfrogging. It's a very, very powerful strategy that I've just developed by experience over the years. And part of that includes listing below what everybody else is listing for. So let's take a look. Keep watching.
It's far from 2021, 2022 levels. However, it's still well above pre-pandemic levels. So take a look for yourself. Now, I want to show you this. This is the average 30-year fixed mortgage rate. So this is a 10-year chart. As you can see, it was averaging in the 4% range pre-pandemic. During the pandemic, it dipped to 3% and then even a little bit below that. But now it's clearly breached the 7% range. It's been floating in the 7.25 to 7.5 range. Now, I want to share with you what the experts are saying, and we'll start.
When he says the experts, I don't know who he's talking about. I think I'm an expert on this stuff. So I can tell you, I started in interest rates that were coming down from 14%. I bought my first property at 10% interest in 1981. But let's keep listening to his predictions.
Start with mortgage interest rates. After that, I'll give you my opinion. The experts expect that mortgage interest rates will end the year lower compared to today. However, their expectation is that mortgage interest rates will fall slightly, so they don't expect rates to fall drastically. The consensus expectation is that it's going to end the year in the 6% range. So that is slightly better compared to where we are today. We're in the 7% range, so that is slight improvements. The analysts are saying that the economy will remain resilient, the labor market will remain strong, and this is going to prevent mortgage interest rates from falling dramatically.
Okay, so keep in mind that the analysts and a lot of the people that are making these predictions that he's referring to, that are making these predictions that he's listening to, this is a political year. This is a year that we're going to be electing a new president, hopefully. And so there's a lot of people out there that are doing damage control, basically to, sugarcoat a turd of an economy that we have right now. We have a lot of big, big problems. And this is why it's difficult to make some predictions in some regards, because you just never know if your government won't muck it up.
So let's talk about home prices in the future. So there is a wide range of opinions. Zillow expects that home prices will increase by 4.9% over the next 12 months. However, Morgan Stanley predicts that home prices will fall slightly over the next 12 months. Okay, now I want to give you my opinion. So let's start with mortgage interest rates. So 30-year fixed mortgage interest rates, that's going to be affected by what happens to the 10-year yield. So the 10-year yield right now, it's relatively high. If you want to predict mortgage interest rates, then you have to use the 10-year yield as your best indicator. So what do we know? We know 2 things. So the first thing is that the Federal Reserve is performing quantitative tightening, and this promotes higher interest rates, just generally speaking. This is a broad statement. The second thing is that I am sticking with my prediction that the Federal Reserve will not pivot in 2023. So there are 2 more FOMC meetings left this year. So I predicted at the start of the year that the Federal Reserve would not cut interest rates in 2023.
I actually agree with him.
So I'm still sticking to my prediction. If it plays out like that, then I do not expect interest rates to change significantly by the end of the year compared to today. It's most likely that the 30-year fixed, it's going to be range bound in the 6 to 8% range. So you can use 7% as your baseline. So there is the threat of 8% because remember,
Oh yeah, we're going up. We're going up. So I appreciate that he's he's taken a measured, cautious approach, and what a lot of people don't, that aren't active investors or don't have my history, is that they don't realize sometimes that there's reasons that things change that have nothing to do with common sense, and have nothing to do with is necessarily what's good for the overall economy.
the Federal Reserve is contemplating another interest rate increase in their summary of economic projections,
I think they will have another increase for the end of the year.
their SEP. So ultimately, I don't expect that we're going to see a sharp fall in the 30-year fixed. So let's talk about when the Federal Reserve will start cutting interest rates. So I'm basically talking about when the Fed will pivot, the Fed pivot. So the Federal Reserve will cut interest rates next year. They're going to cut interest rates in 2024. I just see that as necessary. I see it as a must. I don't see any way around that.
Yeah, I have doubts that there will be any cuts next year.
But you should not expect interest rates, I'm talking about the 30-year fixed, mortgage interest rates, you should not expect those to fall to the 2 to 3% range. You shouldn't expect to see it in the 2 to 3% range in 2024. I'm just being realistic.
Yeah, you're not going to, I don't think you'll see interest rates drop at all in 2024. I think they'll be higher than they are today. And, if they, it'll be such a minuscule, if they do drop it, it'll be just next to nothing. Listen, interest rates dropped like 3% in 2009, very highly reactive to what went on there. We don't have the same set of problems, and the confidence in this country is a mess. So that also plays a factor. The low interest rates that people have, people are going to hang on to their homes because they don't have any choice unless you're a cash buyer. Now that there's a big factor in people that have choices. People that own their home outright, that can afford to sell their home outright, take that cash and go buy another property outright. Those people, they're going to live the same. They have a lot of choices. But people that have borrowed 50 to 70% of their equity in their home, if that's all the equity they have, then when they sell, they have to trade out a 2 to 3 or 4% interest rate for something that's closer to 7%. So effectively doubling their mortgage payment. So those people, you could say they're either stuck now if they lose their job and they're going to lose their home anyways, then they got no choice. They're going to have to pick up and go somewhere else anyways where they can work. Let's keep watching.
So please manage your expectations. Those 2 to 3% mortgage interest rates, I believe that they're gone for the foreseeable future.
Those things are so far gone, for sure. I agree.
And this discussion of interest rates, it's critically important because mortgage rates will play a significant role in determining the value of homes. So especially because of the lock-in effect, which we previously covered very thoroughly. So let's talk about home prices. Home prices right now, they're up 3% year over year. Home prices have not crashed, they're up.
Yeah, so let's talk about that. People are kind of stuck and frozen in place because because most people have a mortgage, right? And the little activity that you see with real estate changing hands, a lot of that is cash buyers. Now, is this a reason to not buy? No. If you're a smart investor like me and my students, you simply buy property based on what the market will bear at the moment you purchase it. And I'll get into that. You want to learn how to make millions of dollars in real estate? I've made tens of millions over my lifetime, and I'm showing people how to do it. Get in my free webinar. I have it every Thursday, 7 p.m. Central. Go to the link below, flipanythingusa.com/webinar. Sign up for it. You can talk to me face to face if you want. Don't waste any time. Hit that subscribe button, hit that like button. You don't want to miss my channel. I've been doing it for years.
People are making all this, okay, so people are making all these predictions. They're making predictions 3 months out, 6 months out, 12 months out. And I seriously cannot believe that people are just overlooking the obvious. I expect home prices to start dipping slightly because of seasonality.
I don't think it's seasonality. Listen, prices are, if this is what happens, when people start losing jobs, they start losing homes. They can't make the payment. They can't make the mortgage. Vacancy rates start going up in apartments. And I'm all about everything. I own commercial, industrial, offices. I have residential. I primarily flip the residential, and I primarily just continue to accumulate more and more industrial, commercial properties. But let's keep listening.
I don't understand why people are not accounting for this. Now, I do want to tell you this. Apart from seasonality, I do expect that the economy is going to get worse. And if that happens in that scenario, my expectation is that it's going to affect demand more than supply. So I'll explain it to you like this. If the economy gets worse, then less people are going to be looking to buy a home. So there's going to be less demand, right? But the question is, on the supply side, is the recession going to get so bad, will it get so severe that people cannot afford to make their mortgage payments?
First of all, let's just talk about who's in the most trouble right now. Financed, the REITs, the anybody that has a loan that's based on a 5-year, mark to market or a change up. In other words, most of the money out there for, unless they're AAA standard investments, and I'm talking about like your Kentucky Fried Chicken, your Starbucks, and a lot of the national brands. Those are good rentals, and they don't pay a very good return, but there is a market for people that will buy those kinds of assets that can afford to have a very small return on their investment, and it works for them. But the investors, the overall amount of investors, and some of the biggest ones that have thousands of people involved with the purchase on funds, syndicates, and REITs, those ones are in trouble if they've got 70% of that thing financed, and jobs start to fall away, people start moving in with each other, doubling up, vacancy goes up. I'm already hearing about some funds from students in my class that actually, one of my students particularly, she said they got a 66% occupancy, and that they're having to refinance because they didn't jump on the refinance train earlier, and so their rates are doubling on the property, and their vacancy is like 3 times worse than it was on average. So they are folding. They are going under. So those type of assets are definitely ones going. And those are the ones that I'm looking forward to going down and crashing, because those are the ones that I can walk in and buy for peanuts. I bought an apartment building. I bought a property for $10 a square foot, that you couldn't replace for $100 a square foot. And it was that exact thing. And there's also what I call a stair-step recession, where things drop and then people think they hit the bottom, and then they drop again, and then they drop even further. So, and I'll explain more of that, or I've had in some other videos, which also, by the way, be sure to hit that like and subscribe. Don't want you to get away from my channel. Let's keep watching.
Basically, I'm talking about a situation like 2008 to 2010, where the recession gets so bad, people can't make their mortgage payments, they get foreclosed on, they have to sell their homes, and it adds to housing inventory. It adds to the supply side of the equation. My expectation is, no, I don't think so. I don't think that it's going to get that bad.
Now, I don't know why he has that confidence, and I'm just going to tell you real quick, I'm going to go back to like 1980s, right? 1989. let me tell you, this area was, I mean, the country was devastated. But I saw places in Texas, San Antonio, Dallas, Houston, where they literally would have a 10% off. Any property you see on this page with this coupon, come down, we'll give you 10% off. And the prices were already less than construction cost. And that's how bad, that's the stuff that when you live long enough and you've been doing it long enough, like I have been, then you actually have seen things that most people haven't seen, or they're too old to remember now. I just got involved really, really young. Even Ben Mala, who is a good guy, honest guy, he shares a lot, but he's been investing for a shorter amount of time than I have been. And he started later, he's a little younger than me, but he didn't have the respect for the interest rates, the fact that it can go up so much, that it can change so rapidly. And so he stuck to his variable rates, and now he's, eating about $6-7 million a year in interest that he has to pay that he didn't have to pay 2 years ago. And, that's significant even at his scale. I don't know that it's going to break him, but, it's something like that is what breaks people, breaks the bank. Let's keep watching.
If we were on that path, let's just say that we were on that path, I believe that the Federal Reserve would rather print money and inflate out of the situation instead of reliving another 2008 to 2010.
Yeah, see, this is when people start, and the younger people kind of talk about this as a means to, if using his logic right now, that why raise the interest rates? If you're going to print money, why raise the interest rates? It causes the same problem, makes the dollar worth less and buy less. And so even if properties stay the same right now, the interest rate makes everything so much more costly to purchase as it is.
But right now, I want to tell you the reality of the situation, and you probably know this, and you might be on the favorable side or you may be on the unfavorable side. Pre-existing homeowners are enjoying their low interest rates, the 2%, 3%, 4% rates. And they're locked in. These people are locked in, and they really do not want to sell.
Yeah, so those people are not going to sell unless they have to leave, okay? Now, the reason they might have to sell is for the same reason that they should stay. Kind of. They have a mortgage. If they have a mortgage and they still have to make a living and they can't make a living where they live, it becomes a problem. People, I don't have a mortgage. I have 3 homes with no mortgages that I live in, that I jump around between. But I'm, as a precaution, I may go ahead and rent one of those, or something. I utilize one at the lake and I utilize one at home, and the other one I don't need to utilize as much as I do. But so these are choices that I can make. But again, because I don't have a mortgage, and believe me, I wish that I'd borrowed a few $1 million on my homes at a very low interest rate. Only because I would use the money for the coming specials that are coming, that I believe are coming. Let's keep watching.
It's the lock-in effect. And okay, so these people are locked into low mortgage interest rates, right? Even if the economy gets bad, even if the recession gets more severe, it's going to be difficult for these people to miss their payments. That's because they have lower interest rates and because their loan balances are smaller, because they bought their homes before they ran up 30%. And additionally, we covered this before, it's because these pre-existing homeowners have more equity in their homes. So to me, honestly, right now, I'm more concerned about the new home buyers because they're getting stuck with higher mortgage interest rates. The mortgage payments are, if you calculate the numbers, I'm sure many of you crunch the numbers, the mortgage payments are just ridiculously expensive.
Yeah, so let's talk about that for a second. I used to say the 400 is like the new 200, meaning 200,000 used to be your starter home price, and now it's been 400. And now a little twist on that, when I talk to people, I say, well, now 400 is the new 600. And now when I say that, what I mean is it costs you as much for a $400,000 home now as it used to cost you for a $600,000 home. It's probably a little bit worse than that even, but that's because of the interest rate has essentially doubled, and that's a killer for new home buyers. In fact, but so you got to think about that. How are you affected by that? You can check the affordability index in your city or your area, and see what it takes to make a living in there based on prices. And you can calculate that can mean rent, that can mean mortgages, either way, as a part of living. But what I would really think about is if people have jobs and they're in an area where they're well-paid jobs, the adjustment is simply your $600,000 homes will probably drop to a value of $400,000, and everything will drop. Everything will drop to a large degree to that working base. That's just say that's within that economic, window of making, say 150 to $300,000 or $400,000 a year. I'm in an area where people make a lot of money at their jobs. They call it Silicon Hills now, is my understanding, and it's heavy with high tech engineers and people that can stay gainfully employed. Working for the companies that we all enjoy. Whether it be Netflix, Roku. And all these other different ones of all sorts.
With these interest rates, many new home buyers are overextending themselves financially, and this gets me worried because this group of people, the new home buyers, are going to be more vulnerable in an economic downturn.
Yeah, so I'm glad he mentioned that. So you're going to see more and more what they call buying down your mortgage. One of my students, which I told him I thought it was kind of foolish, and tell him I didn't like the idea. He was talking about getting a mortgage against a home that he has paid for, so he'd have some seed capital to play with, invest with, which I do believe in. But I told him get a HELOC. But I told him there's no reason to buy down your mortgage. Listen, buying down the mortgage, that's kind of a trick for the seller. In other words, and it's a big danger for you new home buyers, because if they make a deal where they are going to pay to buy down your mortgage, it only is for a few years. So then they'll say your payment will only be X. It'll be affordable for, starting on day one. But on your 48th payment or your 60th payment, then it may jump up significantly. And so what happens is, if that is what's happening, then basically you're fooling yourself, because you're still not really building any equity if you're planning on paying down the principal. You have a lower rate, but it's a time bomb, because all it is the seller. It could be me, it could be somebody else. I'm selling you the property, and I'm like, yeah, sure, I'll take 10 grand off. I could call it taking 10 grand off the price, but what I'm doing is I'm just taking 10 grand of the money you're paying me, and I'm using that to pay down your mortgage, just so you can get a yes and you can buy the property from me. And that's what a lot of people are starting to do right now. But it's a time bomb. You're setting yourself up for foreclosure later on. Listen, anything you buy, and you would learn if you were in my mentorship, you would understand we only buy under market. If the property is worth $600,000 last year and this year it's worth $400,000, well, we're still not going to pay any more than $300,000 for that property, maybe even a little bit less, because doesn't matter. That's history. The 600 was history. So, but that's the problem, is consumers are not how much a month, and that's what really gets you in trouble.
But still, this group of new home buyers represent less than 9% of mortgage holders, but it's growing. It's slowly growing, but it is growing every single passing month. But long story short, going into the end of the year, going into winter, because of seasonality and economic degradation, I do see home prices drifting lower over the next few months. I think that's going to be normal, and I'm expecting that.
Listen, interest rates go up, property values go down. Start having job losses, it'll speed up on the downhill side.
However, ultimately, low housing inventory, it's the same thing. This has been the theme. This has been the story for the past 2 years. Low housing inventory is preventing a housing market crash.
Listen, we had low housing. We had a low housing inventory because everybody and their brother was buying for a while. That's not the problem now. We have low housing inventory now because we have fewer sellers. We have so many people that are stuck, or you could say stuck, but there's people that just can't sell their homes. There's a lot of investors like me. I don't have the problem myself, but there's investors like me that got caught. They got caught with owning a lot of property that they can't get rid of. Ben Mall is one of them, and it's very tough to face the music, especially if it requires selling one of your assets you have a zero basis on, because then you're going to sell it at a reduced rate, and then on top of it you're going to give up a very large percentage of your gain. So,
and that's not going to change over the next few months because we're still in a chronic housing shortage. The builders they're not producing fast enough, and this is that.
They're not producing at all now. They don't even want to build. I'm seeing builders starting to walk away from projects. I've got banks that have told me that I stay in touch with that have told me, yeah, now Tommy goes, we got guys that they're just telling us they're not going to finish the project because they know that when they're done, they're just going to lose more money. It's like, don't throw good money after bad.
The expectation for the next few years going ahead. And I want to tell you this, I want to address this. I understand that a lot of people are saying that home affordability right now is at record lows. I get that. And people are making the argument that because it's at record lows, something has to give. Prices have to crash.
Yeah, people think things have to. No, nothing has to happen. Just because it's bad doesn't mean it's not going to happen. Like I said, I've seen fourplexes sell for $28,000 that you could put 25% down, take it. If it was a VA loan, you could take it. And then if you promise to replace all the ranges and the carpet in the place, they would give you your 25% back. That is real devastation. If the country is devastated as bad as it was in the mid and late 80s, what everybody should be concerned with watching is that the government doesn't let only the big boys, the big companies, the Blackstones, take these assets. They need to make sure that they get broken up so that everybody in the country can have access to them, and then there'll be a lot more home ownership for individuals at very affordable prices.
So I'll tell you this. Yes, I believe that there are cycles, periods of home affordability, when home affordability goes up and down, up and down. I believe there are cycles. Home affordability right now might be very low. However, it doesn't automatically mean that there's going to be a housing market crash in the very near future. It may be years before there's a meaningful correction. Now, I'll end by saying this. I've forecasted and I've mapped out for you 2022, 2023, and I've now mapped out for you the next 5 months leading into 2024. So you can take it for what it's worth. Please subscribe. I thank you for the support. I'll keep you updated, and I wish you a very nice day. Take care.
All right. So this is the first clear value tax video I've watched through. I don't even know the gentleman's name, but hey, nice job. I disagree with some of your thoughts, but I actually agree with a lot of your thoughts as well. The predicting is it's just crazy to predict too much, and I'll tell you why. Government intervention always changes things. The Fed also changes things quite substantially, and you don't know what they're going to do. Biggest problems we have are usually caused by our poorly run government. It's just how it is in every country, right? And ours included. Right now, we've got massive immigration coming into this country. Undocumented. Well, jobs are going down. We have more people coming in that need jobs. We have more people coming in that can't even feed themselves. They're bringing in children. Many of them have learning disabilities, or they just don't know the language and don't know the letter sounds, putting a huge strain on our schools. What's that put on? That puts it upon us as taxpayers. We're the ones that are going to feed everybody in this country. Illegal immigration. We're going to feed them. We have to house them. And now with inflation, it's never been more expensive to do so. So all that is going to factor in on making things less affordable for you and I. We are going to have higher taxes, higher tax rates. Doesn't matter if property values go down. Property tax isn't necessarily go down because what the government has done in the past, locally and otherwise, is that when the values go down, they are used to gobbling up that money. So what do? They raise the rate. So you're paying the same amount of tax you were last year, even though in the following year, even the values dropped 25%. They still stick it to everybody else. So anyways, hey, thanks for watching, and good job here, Clear Value Tax. Sorry, I don't know your name, but anyways, I appreciate the information, and those of you watching again, please hit that subscribe button, hit that like button, get my book if you don't have my book. And I tend to go after a lot of fake gurus, so you might enjoy this little ending here. Otherwise, we'll see you soon.
And listen, time is on a mission to eliminate all the snake oil and the fake gurus that fake y'all. He'll show you how to build an empire, starting with nothing but a desire. All you really need is a good mentor, not a used car bullshit. With time, you'll learn to crush it. Investing like Warren Buffett. With real estate, you cannot procrastinate. Everyone who hesitates is left at the starting gate. Hey, yo, so don't delay and join today. The mentorship and flip anything. USA, go.